Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Hello everyone, welcome back to Broker Daily Uncut. Your host Jack Campbell joining you again on a Monday morning. It's Rate Day Eve, so we have an announcement coming at 2:30 tomorrow. The RBA will hand down its fourth rate call of the year and potentially third cut of the year.
You get to put your wishes out on Rate Day Eve, don't you?
Yes, I think so. So as per usual, I'm joined by Alex Whitlock, Phil Tarrant. Gentlemen, any predictions before the RBA hand down its fourth announcement?
Come on, Phil, you talk to important people.
Do I?
Oh, you tell me you do.
I don't know, maybe. I saw some stuff in the paper over the weekend about US dollars. Sort of, the Aussie dollar against the US dollar would indicate that they're going to have to do something, and they're calling for a rate cut, purely just to try and realign everything. But you look at all the different indicators all over the place and regurgitate what everyone else is saying. What are the banks saying? I think ANZ's predicting one, aren't they?
I think all four of them, all the majors are saying a cut, as well as every economist that's reached out to me.
To economists, maybe you speak to important people, Joe.
They love to get their voices out on articles, but I find in the week leading up to any RBA announcement, all news goes quiet except rate talk. That's just dominating the news. So we try to keep it a bit diverse, but obviously I listen to what everyone's saying, and they're all saying cut. Cut.
Well, a cut of these. Well, it was good to see at the roundtable of property investors. Was that last week? Was it the week before? I haven't seen you since.
Last week.
Last week. And you saw there how intrinsically connected property investors are with rate announcements, right? They make all the decisions around or telegraphing whether or not rates are going to be cheaper, whether it's going to increase their serviceability. So it is a thing, right?
Yeah, and I think property investors are very closely tied with brokers. You had one broker there?
I think it was one or two brokers, yeah.
Yes, and they were...
trying to pitch their wares.
Yeah, but
who would have thought a mortgage broker thinking I'm in a room full of property investors, I'll see if I could do their home loans for them.
Hey, you're getting on the front foot. I respect it.
Yeah.
And it was good for me because, I don't have too much to talk to property investors about, but brokers, that's my bread and butter. So it was good to make a few connections, but that was very successful. Yeah,
so it looks like all indicators are cut for tomorrow, but we'll see what takes place. But again, it's we spoke about it, I think a podcast that we were on about a couple of weeks ago. There is still a lot of disparity in rates being handed down. So all the majors are pretty quick off the marks to pass on the full rate cut, as are the sort of second tiers and other lenders. But there are still a cohort of lenders who are not passing on the full amount at varying degrees, and I think that's going to be something which, as you get more and more cuts coming through,
so who's not passing them down?
A lot of mortgage managers aren't passing them on.
A lot.
Well, what happened? We had the February cut, and there were a few people that were a bit slow to the party, and the media absolutely hounded them. And then the May cut came, and it was like immediate. Most lenders passed it on immediately to avoid any backlash. So I wonder, do you reckon this one will be the same? Or?
Well, I think that mortgage man, we spoke about it. It was a couple of weeks ago, I think. Mortgage managers, if they're not getting the ongoing funding appetite from their funders, I think there's a hesitancy to pass on those full amount of the rate cuts. So I know.
Then it's down to the funders then, not the mortgage managers.
Yeah, but I think it's more of a wider story around the commitment to funding mortgage managers moving forward. But that's probably for another time, I think.
Yeah, well, it's an interesting topic. I mean, already ANZ got on the front foot last week and dropped its fixed rates, I think, in preparation for the rate cut. So obviously very confident in a cut if they're doing that. And I would imagine, lenders over the next couple of days will be doing the same.
Bottom line, when the RBA cuts rates by 25 basis points, it's just sort of indicative. It doesn't necessarily mean that everyone's funding costs have gone down. On the other hand, just because the RBA puts rates up, it doesn't mean that funding costs have gone up in sync. So, but I think it's expected now for borrowers and then for brokers.
It's a posture thing. I think. Yeah. I think if you think about the last cycle where rates were going down, it felt as though back then that lenders weren't as responsive as what they are this cycle, and I think that's public pressure largely. And I think the wider connectivity, people can have a bigger voice now if they feel as though they're not getting.
It's going to also feed into who wants to grow their book. If you want to not. There's two sides, isn't there? There's what you're sort of bringing new customers in and what you got your existing book on, right? So but if your book is out of sync with the rest of the market, you're going to lose because people are just going to refinance out. Or at least people who are sort of connected and informed. And you'd hope sort of customers of brokers. The problem is brokers don't have visibility. They don't know once you've brought a customer on. I don't know that Phil Tarrant, who took a mortgage out 4 years ago with X lender, I don't know what your rate
They make
is.
it very difficult to get that.
Yeah. Well, I think it just is difficult to get that. It's not a matter of anything calculating. It's look, we've talked about this a lot, and it's an opportunity, but also it's an obstacle for brokers. You have to go to the borrower to find out what their rate is. You can't. Yeah. You don't know what rate it was that they took that loan out on, and then you may well not know as a broker whether that rate's been handed down or not. So it's at the end of the day, it's up to the borrower to be vigilant around what their rates are. And Aussie borrowers really are. They're very switched on.
They are a lot more, but there is technology out there now where you can subscribe into it to actually make that information available to your broker. But uptake of that's still taking some time. But anyway, we'll see what happens tomorrow, mate.
Well, it was the first cut in over 4 years, was it, February? So I'm sure that's why there was so much pressure from consumers. Does that usually die out after a bit of a cycle comes in of rate cuts?
Whether consumers are being vigilant on their rates?
Yeah,
no, I think the world has significantly changed now. Borrowers are so much more dialed into their interest rates, and you wrap that around the ongoing inverted commas cost of living crisis. I think everyone's trying to save a penny where they can, so they'll be on it. Do not worry. And I think if they're not, it's the role of the broker to ensure they're contacting, communicating with every single one of their clients, saying, "Hey, there was a rate cut."
I think Australian borrowers are really switched on. I really do. I think one of the things I've noticed here for decades is how aware Australians are around changes to the cash rate. I think people are pretty dialed in, and probably such a big thing here. So much more so than many other places in the world, home ownership and the around property, whether you're an investor or a first-time buyer or, just sort of a homeowner. I think people are very, very, very switched on. It's a very sophisticated market here, and I think you've got sophisticated buyers, borrowers. So, yeah, I think people are pretty aware.
Well, keep an eye on your inbox tomorrow, 2:30 p.m. The rate call will be handed down, and you'll hear it here first on Broker Daily. We'll just throw to a quick break. We'll be back after this. And we're back with Broker Daily Uncut. Something I wanted to chat through with you, Phil. We did an article last week on the generational wealth transfer that's expected. I know you've been talking about it on the podcast a little bit. There were some people concerned about the impact that's going to have on the property market. Is that something that you think is going to have a major shift over the next few years? Baby boomers passing down inheritances and whatnot?
Oh, it's quite a big question. Yeah, there'll be ramifications for it. What I sort of find a little bit sad is people sitting around waiting for their inheritance, and that's going to be their sort of mark to actually either get onto the ladder or do all the things that they've wanted to do. People are living a lot longer than what they used to, and waiting around till you're 50 or 60 to get an inheritance so you can actually start making a move in the property market. Don't know about that. There's ways and means to be doing that beforehand, but outside of that, there's going to be a huge transfer of wealth into new cohorts. And it's funny how quickly people's attitudes change when they inherit a whole bunch of money and then they become a property investor or they start buying property. They don't want their houses to go down anymore. They don't want property to be more affordable typically. They just want to go up in value. But there's going to be a huge transition moving forward.
Got no inheritance tax here.
No inheritance tax.
Which in the UK is... the government comes and sharpens up its knife and takes a pretty sizable chunk.
I think we used to have it, then they got rid of it, and I know that's always sort of being banded around having some sort of death tax, inheritance tax. There's got to be a lot of people coming into money who might not be sophisticated enough to probably have a smart measure of how to deploy that money correctly. So what I would say to all those people is to make sure they get the right advice around it. And a mortgage broker can obviously, be in and around that process and potentially ensuring that their clients are speaking to the right advisors, proper financial advisors around it, where to deploy that dough. It just doesn't go into property. There'll be people putting them into other financial instruments for the purpose of investment and providing retirement. But, that's not a bad story for Australia. It's I think an objective that most people would like to contribute to, not actually have to put their hand out for a pension if they can avoid it as an Australian. So if you're coming into this sort of money, make sure you're putting it in the right way. But running in parallel with that, you've got to be very careful where you put it. If you're going to start putting it inside of your super fund, there's obviously new taxes around it. You never know what's going on. So you need to get the right advice. With it. Absolutely.
I think it's going to have a major shift with all this money getting passed down. But I think what's probably more concerning is the supply issues and, the 1.2 million target that is yet to be met. They've made a bit more effort this month. We did a story last week with the ABS data, but I think that'll be more of an issue rather than pushing prices up. Is there enough availability for everyone?
Well, this has been the ongoing, it just doesn't change in Australia, sort of housing supply. It's always tight. And there's pros and cons with that. It's tough when you're renting or if you're buying, to get into the market. On the other hand, what you don't want is a massive glut of property, sort of huge, amounts of vacancy. And we've seen that happen, worldwide, and the impact that has, the lasting impact that has on any economy. So Australia's always on the tight side, wouldn't you say, Phil?
It's always on the tight side, and it's a role of the respective governments, whether it's federal, state or local, to balance that supply and demand equation effectively. Now, I think it's at the moment it's a little bit out of kilter. They need to be working on it, but we've spoken at length on this podcast around it. It's a big problem to try and solve.
It's not a quick fix either.
No,
it takes a long time and it's expensive.
It's expensive. These big sort of headline numbers of building was a 1.2 million properties or whatever. It's a nice measure. It's a nice objective, and it's nice to know how much further away we're getting from that objective every single month that passes, which you've got to put a question mark on. But it's a tenuous balance, the housing market in Australia, and we don't always get it right, and we're certainly in that situation right now. But this will, this transfer of wealth will potentially inject more money into real estate transactions. How do you, if you have aging and your parents pass away, well, you need to actually go through a process to liquidate whatever that sort of investment is, and therefore there will be property sales, and maybe accelerated property sales as a result of that. So that money will then be deployed back into the system. The benefits of that is obviously stamp duty and other related taxes. So this is the property economy in action.
But not everyone's going to want to put it, like if your parents have got a portfolio of property, or maybe just a sort of a valuable home that is inherited, and maybe by a number of sort of children, people don't necessarily want to put it back into the property market. Once there's people want money for lifestyle. Yeah. There may be other investments. It's no one really knows quite how it's going to play into certainly the property market directly.
No one does. You got to remember also, it's when estates start getting sliced up, there's lots of kids in there. That money often doesn't go a long way. It may change someone's ability to raise a deposit faster for a property, or might change the size and scope of the property they're buying. But there'll be accelerant factors. There'll also be a balancing side of it as well. So to be played out.
I think there'll be a lot of fights too. That's generally what happens when inheritance get passed down.
You want to try and avoid that sort of stuff, but yeah.
I think everyone has a story of that happening. But yeah, anyway, we'll see how it goes. Some big things coming in the next few years, but we'll just throw another quick break. We'll be back after this. And we're back with Broker Daily Uncut. I did an article last week. I hadn't really spoken much about it, but I had someone reach out talking about clawbacks and did a little research on it. And they reckon $15,077 a year it's costing on average brokers, clawback fees. I know you guys did, I think it was when I was in Europe last year, you guys did a podcast on the whole clawbacks issue. Is this something that you can see being changed at all, or is it
what was the number? $15,000 in clawbacks?
In $15,077 a year on average.
Where's that number from?
I'll have to double check, but it was research from some company.
Yeah. I thought the number would be bigger than that for the average broker, but the clawbacks has been ongoing.
I think you got to look at. There's no one broad brushstroke for clawbacks. It may be that you have a customer that has chosen to refinance, within the set clawback time, and the broker writes another upfront, moves the borrower away from one lender and goes into another, and so there's a clawback, but it's also offset by another upfront. On the basis, I think in most instances where it's driven by the borrower, so maybe they've taken out a low doc loan, for example, because they've not had the tax returns, and then they're able to now change that to being, now they've got the documentation to write another loan. So that's one scenario, right? So clawbacks are understandable there, but there are other issues where clawbacks can be very punitive to brokers. So you kind of can't look at it just through one lens. You've got to kind of break it down.
I think where it hits people hardest is the sole traders and operators, where a deal can make or break the business, and having that pressure on them. I did just find the source of the research, FBAA, so reliable data. But is it something that's heavily ingrained, or is it something you think can be changed?
I think it's more of a philosophical sort of view from the brokers, where they're like, we go about originating these loans with the best intent, with the consumer's needs in mind, and they do the work and they get paid for it, right? But then that work can be taken away pretty quickly through a clawback within a period of time that they have no control over. So the broker's position is that, well, we don't know that we're going to refinance or move away from it. We didn't know they're going to discharge that loan, whatever it is. So therefore, we've done all that work for free. And this is their point. We do all this work and we don't get paid for it. Point number one. Point number two, when that clawback comes, we don't know when it's going to come, and therefore it can really put a lot of strain on cash flow of a business. If you get a huge clawback in one commission period, you might end up with no commission whatsoever. So how are we expected to live? And I saw some research, it's probably a year or so ago, and I can't remember who did it, but they were talking about the anxiety and stress that places on a lot of brokers, and mental health issues connected in and around that, which has some merit, because there's so much uncertainty there. You just don't know, and this is the nature of broking. You're not always 100% sure what sort of money is going to be coming in at any given month, because of the intricacies of how lenders get paid and when they distribute that money and when settlement dates fall and all this sort of stuff. So there is a level of anxiety there for a lot of brokers, because they just don't know. So throw in a clawback and it can completely change things quickly. So I think they just want to be recognised that irrespective of whether or not a clawback happens, they've still done the work, and therefore they still get paid. And that would be their key position, I would imagine. You've got to
kind of look at it. You've got to look at the whole ecosystem because the lender has also done the work. And if, a loan is written and then 7 months later goes, it's unprofitable for the lender. There's a whole piece, to be looked at. And this is one of the things with cashbacks, and you can end up with brokers taking up cashbacks. Lenders are very happy to take them when it's new business, but they're not happy when it's business leaving their book. I don't know, have you done an in-depth report on clawbacks?
No, I think it'd be worth visiting though, because I know there are a few lenders that have eliminated them.
I think look, it's if you take a one-dimensional view, brokers are very unhappy about clawbacks for very obvious reasons. I think there's an opportunity to explore it in detail and to look at, if there is a better model, and to get different points of feedback from the various different cohorts. There's never going to be a perfect solution, but it's probably worth investigating.
Well, I think originally clawbacks put in because of this view that brokers will just churning. So let's just stop them churning, where they just every 6 months, 9 months, whatever, they just refinance a customer, and get another upfront on it. We've moved way beyond those days, of brokers potentially acting and operating that way. And I tell you what, doing a home loan today is intrinsically a lot more difficult and complex than what it was 10 years ago.
So a bit of an outdated practice.
It's outdated, but there's got to be, to Alex's point, there needs to be a middle ground somewhere, and there's got to be some measures of whether or not. The clawbacks largely, in most instances, are probably outside of the control of the broker, and that should be considered and recognised. It's when you can if you start seeing a pattern of someone refinancing a client every period of time, well, there's a pattern there, and maybe there should be some clawback connected in with that, or maybe there's some sort of clawback score on a particular broker if they have the discipline to not do that as part of their business practices. Maybe not all brokers are created equal when it comes to clawbacks.
But mortgages have to be profitable via the third-party channel. This is very, very important, and clawbacks have a place. You don't want lenders, large or small, saying that the third-party channel is no longer financially viable for that lender to distribute mortgages. That's not what we want. But I think there's place for a sensible discussion around clawbacks, to look at the whole ecosystem and to look at how how you can have an equitable model.
Yeah.
Well, record market share, I'd say now more than ever, brokers have the potential to incite some change. But anyway, that's all we have time for today. If you want to see more content, visit brokerdaily.au. If you want to reach me directly, if you want to discuss clawbacks, editor@brokerdaily.au. Thanks for listening.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.